Hi everyone, this week we're going to be going over the first couple pages in the chapter 3. We're going to be figuring out food costs. So we're going to be defining food costs and explaining how managers track and analyze food costs. Explain how to calculate the cost of sales and how to calculate the actual cost of sales. Describe how to calculate the food cost percentage. So what is food cost? Many people think that food cost simply refers to the purchase of the food. It actually refers to the amount of food that is actually used, the price associated with that. Not just what you buy, but everything that was used during a certain time frame. So food cost is the actual dollar value of the food used by an operation during a certain period. I think I just said that one. It includes expenses occurred when food is consumed for any reason. Food cost includes food given away, wasted, or even stolen. Now, I don't really like the way they say this in the book. Through normal inventory, you're not counting what's stolen. Obviously, you don't know until you run the numbers and you do all this to know what's stolen. So I just don't want you to. And then waste also, not every restaurant counts waste, especially when it's small items. Now, if it's like a whole case, a whole bag, a whole container of something, that might get written down somewhere. But overall, if you're throwing away 1 or 2 tomatoes, that's usually not getting accounted for. So when we're all done with this process and you're left with that variance, then that variance you can try to figure out, is that average waste? Is it being stolen, over portioning, anything from there? But it's not something you're actually calculating now, and it kind of seems like that in the book. Now, sometimes food cost is also referred to as cost of sales, or your COGS, the cost of goods sold. So it only includes food items, not beverage items, even though the concept's still the same if you're going to be inventorying beverage items. We're just going to be focusing on food. You do not want to count your beverage items unless it's involved with the recipe. And that's something we'll touch on at the end of this and go into more detail next week. So calculating basic food costs. The formula for calculating food cost starts with adding your opening inventory plus all your purchases. With those two together, you're going to subtract all your all of your closing inventory, and that will give you your actual food cost. So here's the formula: opening plus purchases minus closing gives you your cost of sales. So we'll talk about inventory. So inventory represents the dollar amount of food in storage. And we can express it in multiple different terms. Units, values, or both. I know we've kind of touched on that, and we're going to go over it in a couple slides into some more detail. So with inventory, when one period closes, it automatically starts the new one. So for example, when you count your closing inventory of July, that automatically becomes your beginning inventory for August. Oh, that doesn't quite show up. All right, while most inventory is taken monthly, it's also to know that a period can consist of any length of time: a day, a week, a year. The book does even talk about more of a fast foods do more of a weekly inventory versus full service, who does only monthly inventory. I've worked for both, and there's still inventory that is taken weekly and daily. It really depends on what you're selling. Like sometimes in full service, you might be doing more of a daily inventory if you have special items or items that are very high in cost, or items that you are starting to notice your food cost is not good on. So the more you do inventory, the more you're going to be able to stay on top of any of these variances before you even find out about them. So purchasing. So in addition to taking the regular inventory, you need to record all these purchases. They include any kinds of forms of credits, return, or invoice adjustments. At the end of a period, there should be a record of total food purchases made. Holds true for anything that you bring into the restaurant. It is of utmost importance that invoices are collected and safely stored. So here is, I am sorry, and then let me adjust this real fast if I can. Not quite what I want to do, but we get to see the bottom of it now. So here's an example of a purchase log. So it has all your invoices, the date, invoice number. Those are really important to make sure you have, if you have multiple invoices from a vendor, this will make sure you keep things straight. And it's all broken down into different categories. Now the book, later on in the couple of chapters down, they do talk more about invoices, but I want to talk more about that now. We're going to kind of take a couple step back and talk about how you would even go about doing inventories, because we've just kind of talked about doing it, but not really how to do it. So, I mean, physically, you have to count everything that's in the restaurant. And how you count it a lot depends on how you are getting it from your vendors. So right here, I have found some samples on the internet. So this one is from Sysco. So as you can see, the way how these are ordered. So right here we have our, looks like we got some turkey wings coming in. They ordered 3 cases. There's 1 pack inside the case at 30 pounds. So they are doing it by the pound. So you're going to be inventorying this by the pound. So when you go and you look in your freezer, because it says this is frozen, probably actually will be thawing it, but maybe you have some in both. You have 3 and you're slowly pulling them out to thaw out. So the ones that are opened, those are the ones you're going to want to weigh. You'll be weighing it by the pound. So over here we have canned and dried selection. So they bought 2 cases, and inside there's 12 packages, 2 pounds each of green, what's that? Green bean whole frozen. Okay, I'm not sure there. Oh no, wait a second, this is frozen down here. Excuse me. So you're looking at 12 different packages, 2 pounds each. So you might even be inventorying this by package, since the packages are so small. 2 pounds, that's probably going to, I mean, you're not going to have a 2-pound portion on a plate, but it could go either way. You could be counting different ways. You could be counting cases and counting packs and then weighing out the pounds. Really, it's just going to kind of what fits your restaurant as well. I know I say that a lot, but we'll be getting more and more detail as we go throughout the semester. A lot of this is just kind of a general overview, and then we dive in deep. But this is another one I wanted to go through. This would be considered a broken case. So right here we have 1 sleeve, which is 1 gallon of Italian dressing. So chances are they normally sell that in 1 case, which has 4, sometimes 6 1-gallon jugs inside a case. So you'd be counting that by the gallon. That might even be like 0.75 of a gallon when you're counting inventory. You might even want to break it up by ounce if you're, want to be that detailed. Another one here, 1 case, 6 packages inside that are 1 pound each. These are all broken cases. And then I have another one as well. This one looks a little bit different, but it's still the same concept. So here we are, we ordered flour, high gluten flour. Ordered 6 of them. So we ordered, and then they said they shipped 6. Over here, those are 25-pound bags. So you will be weighing these, by bag and by pound for once the bag is opened. Here we have 1 case of marinara sauce. Inside there are 6 number 10 cans. Those really big cans. Same with this one as well. Tomato puree, 6 cans. Each, and here we go, each. So in the other one, they said sleeve. So this one says each, or it says piece. So they got 2 pieces, garlic chopped in oil, 32. So that probably just came in a bigger bigger containers. Not all things when you get into ordering, we'll talk more, but you can't always break open cases. So over here, you know, how many at what price, and this gives you total price. But what I like about this example right here, it shows an adjustment. So it looked, oh, maybe not. I don't know what that, oh, they probably didn't receive it. Looks like maybe they scratched it out because they didn't actually receive it. I thought it was $24.95 and they charged $21, some kind of weird adjustment. So the book does talk about adjustments and just the price difference. Maybe this priced wrong, or you didn't get as many items as you asked for, and then you need to get an adjustment or a credit from your vendor. And we'll talk about that again in like chapters 5 and 6. So as a review, we did talk about this. Opening inventory plus purchases minus your inventory cost will give you your cost of sales. Now, when you talk about the actual cost of sales is when you're bringing in all that other stuff that's not associated with the selling of the food. So this will include food given away, wasted, stolen, but they can also get broken down into even further into credits and transfers. These are a little bit different than the credits we talked about from your vendor. So credit is the cost of goods. Like I said, they're not directly related to the food service operation. So some of those would be employee meals. A lot of places will do that, maybe even a family style meal. Everybody eats before dinner service, before lunch service. Next one, your comp meals or complimentary meals. For whatever reason you needed to give somebody free food, whether it just be somebody that complained, hopefully not, or, you know, somebody that is just like a member of the community, somebody important. I know the book talks about police officers. A lot of them can't accept goods like that. So, and then also the grease sales. So it's just like a recycling. You will get money back for recycling oil. So all of that gets added into, well, I guess in the book they say it subtracts from your purchases. I just don't want you to think it gets subtracted from like your purchase log or anything. It just gets accountability. I guess that's more the best word I want to look for. It accounts for that cost. Now transfers is just like it sounds, transferring a food from one part to another. So you have your food to bar transfer. So like if you need to get any kind of citrus or olives for drinks and stuff, you get those from the back of the house. That's where the costs are associated, but you need to transfer it to the front of house beverage sales. And then it goes the opposite way. So any kind of alcohol that needs to go into the kitchen. So you're going to be using wine for some sauce, or you got some beer battered onion rings. Another thing the book doesn't talk about is transfers from another location. If you own multiple restaurants, or if you're a manager of a chain restaurant that has other locations, you ran out of something and you're borrowing it from that. It'll give you transfers either way. I mean, if you get food in from somebody else and it's not accounted for, it looks good on your food cost, but it's going to be ruining their side if they don't account for it either. So why do managers care about cost of sales? Now, calculating the cost of sales on a regular basis allows us to identify problems. Establishments that conduct regular inventory and calculate the cost of sales generally have a higher profit because they're staying on it. They're able to nip it in the bud, so to say, before it gets out of hand. Now, food and beverages are the two main profit centers in most food services. It is essential that the cost of goods is calculated regularly to ensure effective cost control. So when we're doing it as a percentage, once the food cost has been calculated, the next step is to calculate the percentage. This is how you normally, they say judged. I don't like how the way they put that, judged. This is how you can analyze it better. So it says it can be analyzed by comparing it to company standards, historical costs, industry standards, your standards, your budget. So in order to calculate it, you got the food cost divided by the food sales is going to give you a percentage. So the example here, 7,500 in food cost divided by the 30,000. That will give you 0.25 times that by 100, and you got a 25% food cost. Just to break it down to make it a little bit more relatable. So for every dollar of sales, 25 cents went to that food. So food cost is a variable expense. It is supposed to decrease and increase as the sales do. But if the controls are not followed, it might not. If you got, I've worked for a manager who did not leave the office to do the truck order. So she would just order the same thing all the time. We had too much inventory, not enough inventory. It was an ugly mess. And I even know there was some comments about that in discussions as well. So every restaurant needs to establish that standard, that benchmark. You know, you need to be able to have that, and it reflects on your current menu, recipes, your prices. All of that can be prepared to an actual food cost. So if the standard food cost percentage is met every month, the standards are set properly. Your systems are working, yay! But if it's not met, maybe something's not right. Either you set too high, too low, ordering. There are so many things that it could be. And the only way to accurately calculate food costs is to cost out every single menu item in the operation. And that's what we're going to be doing next week, but we're only going to do one as, you know, just the concept. So over here, I just want to show things and maybe put a little bit more perspective. So here it is, the food cost. And then when you add in all the other expenses, that was a difference of 1.9%. Now, if you look at it from a dollar variance, I think that's where most people feel like there's more of a difference. When you hear 1.9, that sounds small. But when you hear $765, that shows a little bit more importance. Oop. This other example they have in the book here, let's go over this. So the graph is just showing what you are buying versus what you are selling. So you look at January, that's pretty close to breaking even. Their sales were just above their costs. They probably didn't make a whole lot of profit, if anything. By the time they added in everything else, they might not have even broke even. And then February is like the extreme opposite. Now they increased their sales by like 50%, but decreased what they brought in by almost 10%. And over here in March, that looks beautiful. That's kind of what we're looking at here. You know, little influxes you'll see sometimes when you maybe do a big order and you had a snowstorm or something, sales were down. That happens. You just order less the next week. You know, hopefully not as much expired. There wasn't too much fresh produce or protein that was wasted. But the little variances will happen. But when you see these big extremes, you need to maybe look back and wonder what happened here. Is there something I can prevent for next season? That is all I have for you. I have the key terms here like I do at the end. A lot of these are mostly more related to next week's topic. Like I said, this is a very big chapter, so I broke it into two. Just going to focus on food cost, and then next week the actual costing of the recipes. This week there's also some extra videos under the additional resources. If you have a chance, please check those out as well. And that's it. Have a great week, everyone.